Welcome back. It's the commodity names which are outperforming today. Hindalco, SAIL, NMDC, Tata Steel, all of them are showing you big moves today on pretty good volumes, and there has been an uptick in the last 1 hour or so. But let's talk about the markets on the whole. Markets have turned decisively for the better in the last month and a half. The Nifty is up more than 2,000 points from its recent lows, and the FIs are back in the markets. We're now joined by Jigar Mistry of Buoyant Capital to talk about the way forward now. Jigar, morning, and thanks so much for joining in. At these levels, after it appears the easy pickings are behind the markets now, how would you assess the risk reward, and what is the best approach?
Good morning, Rima. I think I completely sort of agree with you in that, we were due for one sort of a rebound. That seems to have happened, but, we must not forget that the Fed's job is essentially to keep the inflation low, and inflation is not just current prices, but also the future expectation of prices. And until the time that happens, it's not going to be a very easy cakewalk sort of a run that we will likely witness. Now, we have historically discussed that there's a funny way in which all of us sort of are used to evaluating inflation, in that, if something that is valued today at 100 becomes 120, that's a 20% inflation. And if 120 stays 120 next year, that's a 0% inflation. So the inflation has fallen without prices having actually fallen. And at 0% month over month growth, I think it was JP Morgan report that suggested that you will essentially start coming towards closer to those target 2% numbers by the next 3 months or so. So until that happens, Fed will have to make sure that, the escalatory pressures does not come back to the market. And they will sort of, have to keep a close eye on that. With regards to India, I think the numbers we are watching very closely are the trade deficit numbers. We reported something like $30 billion plus in July 22. That's the highest number I have seen. Exports essentially dropped by something like 5 billion. And part of it, I think, had to do with the fact that petroleum products and steel, the duty was imposed. And this sort of number, will be a little alarming. Rupee, remember, has been among the best performing currencies. Indian markets on a 1 year basis is, I think, the best performing or second best after one other index, which is smaller one. So, all this will make us to conclude that, part of the gains that were there have happened. One must be relatively cautious going into sort of the markets and approaching it. So, that's how we are deciding to play this for now.
Right. Hi, Jigar. Good morning, and thanks for joining us. This is Pavitra. So, in this global context where we're pretty much just waiting, right, for data to come out so that we can react to it. In that context, how do you think now you should position yourself? Is it, and what are the sectors that you would feel relatively more comfortable in at this time?
Good morning, Pavitra. I think, the last time we discussed, and I might start sounding a broken record very soon. But let's say if you are building in a scenario that interest rates stay higher for longer, in that scenario, part of the high duration assets, the valuation of those should have fallen. Many of those companies' prices have also fallen. Now, the sad part is that essentially that results in a strong dollar, and FIs then choose to exist, and they sell holdings that are the ones that they own the most, and that is the banking sector. Now, ideally, in a rising interest rate scenario, banks tend to do a lot better, and in terms of fundamentals, but the stock prices get hammered down because FIs are exiting, and that is one sector that presents a great opportunity, improving fundamentals and falling prices. That's one sector that we have been fairly positive on over the last 3 or 4 quarters, but that continues to be the preferred name. Some, bounce back stories or the reopening stories are now getting sort of very strong traction. You must have seen Indian hotel results. For a 38,000 crore sort of market cap, the debt virtually 2,000 crore will get to zero debt by the next 2 years or so. The earnings will rebound to something like, maybe EBITDA could go up to 2,000 crores by the next year. And people want to travel, people want to stay out, and the foreign travel is returning as well. So those names make a reasonably good bet as well. Microfinance, with some hiccups with this quarter numbers, but that's one sector which has been extremely cyclical, and that sort of can make a positive turnaround, for the next 2 or 3 years. So that's one sector which we are fairly keen on. Autos and ancillaries we discussed, I think, a couple of months back. Those have had a very sort of decent move. Some auto ancillary businesses, from what we discussed with them, are in a very, very good position. So that sector is interesting. And lastly, insurance data has not been bad either. So general insurance, life insurance, with the new regulator and their willingness to be open about business, that provides a very interesting opportunity as well.
Hi, Jigar, morning. But all of these themes you mentioned, banking, insurance, reopening trade, these are very crowded trades, right? Everybody is looking at these sectors and for the obvious reasons. Where are you looking for, themes in terms of alpha generation? I mean, are there new themes you're exploring, perhaps lower down the market cap order?
Good morning, Sumaran. Not really. See, if you look at the data going back 2003, and you break down the small cap versus large cap index, the returns have essentially been similar, but they have not come at the same time. So if you break it down, say between 2011 and 20 or 11 and 17, small caps outperformed dramatically. Then between 18 and 20, the small cap index was down 50%, whereas the large cap was down only 12%. Which essentially turned around. So April 2022, almost until going back, I think 3-4 months, that index made a complete turnaround. Increasingly, the time right now we think is to be a little more defensive. It can be a crowded trade in terms of the themes we just mentioned, but you come to think of it, 80% of the time, it might make a lot of sense to be in the crowded trade, and only when that goes a little out of its axis, that's when you have to sort of turn around and get onto the other side. So for now, I think a large part of outperformance or alpha can be generated through the weights that you run. The index has a certain number of weight. If you are a lot more positive, then you can run that weight. It can also come by running a reasonably concentrated portfolio rather than what the index that you are tracking at. And instead of going into, lower down the order, we don't think the valuations of a small or a mid cap is all that conducive. We were almost, I would say, 65-70% into small and mid caps by COVID, at the peak of COVID, that is. But now that's no longer the case with our fund. So we are reasonably large cap now, and we are looking at protecting the capital in this round over the next 3 or 4 months before we turn fairly aggressive again.
Okay, the focus has to be to protect your capital, and then perhaps towards the end of the year, buoyant capital might turn aggressive and look at even smaller and mid-cap names. Jigar, thank you very much for your time. One of the sectors that you're bullish on is insurance and the